Okay. Good morning, good afternoon, good evening, wherever you are in the world. I'm Andrea Roncoroni here at the Energy and Commodity Finance Research Center of ESSEC Business School. And this is our webinar series. I'm very glad to welcome Danko Turcic. Thanks for coming. Danko is Associate Professor of Operations and Manufacturing Management at Olin Business School, Washington University in St. Louis in the US. Before completing his PhD, he was a quant in a treasury department of the US Bank Corp in Minneapolis, where he worked on modeling of financial and operational risk. Danko research focuses on supply chain risk management and on supply chain contracting. More specifically, he has skills in stochastic processes, distribution channels, inventory control, production planning and scheduling, operation strategy, supply chain management. And he extensively published in relevant and top-level academic journals, including Manufacturing and Service Operations Management, Management Science, and Marketing Science. So today, Danko is presenting a paper on buyer-preferred commodity price risk allocation, a theoretical and empirical investigation of the BMW supply chain. Thank you, Danko.
Okay, thank you. I should be using this or that. Doesn't matter. Okay. Okay. So thank you for the invitation. This is a new setting for me. I've never presented this paper in an hour talk before, so it's a fairly new work. I've presented it in 20-minute talks, not an hour before. And I've never done a webinar, so it's kind of a learning experience for me. But I appreciate the invitation and the hospitality, and hopefully we can kind of learn something from each other. So what I'm going to first do is I'm going to discuss the kind of the motivation behind the paper and explain what we are trying to do and why we are doing this. And then I'm going to describe the model that we are using. There's two components to this. One is we have a modeling part where we actually develop a theoretical model and so we actually prove some theorems and propositions. And then we try to test the model and see whether the predictions actually amount to anything, whether we are actually predicting something that's happening in reality. So I'm going to talk a little bit about both, and feel free to interrupt whenever you have questions. So first, let me give you the background. So here, what we see is a picture of a car. And I picked the BMW because the data that we have for this paper came from BMW. So we picked that car and we kind of modeled, a lot of the theory model that we developed is based on their actual production processes that they are using. So one thing that you observe is that car manufacturers, such as BMW, don't really make a whole lot. What they do is they buy many parts from other suppliers, and the other suppliers are supplying a number of components that kind of amount to the whole car. Oh, I think I'm pointing at that basically amount to the whole car. The other thing that you see from the picture is that many of the components have a surprisingly small number of suppliers. A lot of them have one, some have two, but mainly they have single suppliers per component. We actually take advantage of that in the model because it kind of simplifies the modeling, but I point that out that we chose, so we work with a single supplier model, but it's not necessarily because it's convenient, but also because it describes the empirical reality. The other thing that's relevant to this work is that a lot of the parts that they buy have a very heavy commodity content, which is why I guess this talk is relevant to the commodity center here at ESSEC. So a lot of the commodities that are in cars are aluminum, there's automotive steel, there's some rare earth metals which are becoming very important in electric cars because they go into batteries. So maybe a decade ago, rare earth metals was a non-event for car manufacturers, and now it's becoming a huge component of their spend on commodities. And then there is some other stuff like oil derivatives, but the big players are aluminum, automotive steel, and then stuff that goes into batteries. Here's a picture that you cannot see because it didn't come through on the PDF. But what it basically shows, I'm going to gesture with my hands, is that it compares volatilities of metals that BMW buys to volatilities of other well-known commodities, such as fuels and then food. And then it compares it to currencies. And what you discover, which is kind of interesting, and to me the picture was quite telling, that in comparison of the four things that I mentioned, commodities, currencies are relatively the least fluctuating part. Oil derivatives are the second least fluctuating part, and metals are one of the most fluctuating parts. So actually, if you think about it, aluminum and steel are actually more volatile, at least on the picture, that's what the picture shows, than some of the well-known commodities that we think of as volatile, which are fuels, right? So that's kind of interesting. The other thing that you actually do see is that BMW and its suppliers do buy these fluctuating commodities, but the price of the car doesn't change very much. If you go to a dealership, the price of the car does not fluctuate with prices of commodities. It basically stays more or less flat. And so if you think about that, somebody must be eating this volatility. And the whole paper is basically who is eating the volatility and why. Okay. So the third important part about this paper is that commodities that BMW buys cannot be just broken down by is it aluminum, is it steel? They also trade in very different markets, which is actually very relevant for BMW. There's commodities that trade in transparent markets, which are here, and those include aluminum and copper. By transparent, I mean that if I want to know what the price of aluminum is, I can simply look it up in a newspaper, and I'm fairly confident that that's what the price is. Also, a large part of commodities that they buy trade in what we call opaque or murky markets, which are markets that are not as smooth. And the reason is that these are commodities which are more boutique in nature, are mainly purchased by few manufacturing companies that are not widely traded, and you cannot really get reliable prices for them. And unfortunately, large part of commodities that BMW buys are of that nature. So, for example, automotive steel, some grades of plastic, and then rare earth metals would be those cases. So those are cases where you don't really see the price very well. You have some kind of notion of what the price could be or should be, but you mainly rely on other players in the market to tell you what the price actually is. And here is a recent article in Wall Street Journal that came out, let's see, June 19th, 2018. You can download it. And it talks about exactly this issue. It talks about this issue in a different context. It says it's meant for investors, and it says, do you want to buy some rare earth metals? And they are basically telling you, watch out, because the prices are hard to come. It's hard to nail down the prices for these things. And it's actually become so bad that LME, the London Metal Exchange, tried to launch contracts for those things, and they even couldn't get reliable prices. So if you think that the LME cannot get reliable prices, then many other big players cannot get reliable prices. So here are the facts, and this is how they lead to the research questions, and then, kind of why is this a relevant question for them? So basically, the fact is the following. This is a supply chain setting where you are in the business of manufacturing. You are not in business of speculating on commodities and making money by selling and buying. You are in business of manufacturing. So one of the first objectives that you have is to maintain kind of a steady supply, steady supply chain where your suppliers don't go belly up just because prices, go up and down. So one of the things that you have to do is you are giving out long-term contracts, and commodities fluctuate very highly in these wild swings. So there is an incentive for you to have some kind of a risk-sharing scheme with the supplier. And the reason is that if you ask the supplier to eat all the losses, then it may very easily happen that they may basically say, at these prices, I'm no longer interested in supplying to you, and it's a disruption to your chain. So risk-sharing is generally a technique that companies use. The question is, to what extent do you want to risk-share with somebody who is purchasing commodities for prices that you don't see very well? So there is an information asymmetry in the system, and the question is, do you care? What kind of prices do they have an incentive to report to you? Do you want to risk share with them? To what extent do you want to risk share with them? And that's pretty much the question that we are studying in this paper. Okay, so is it clear to everyone what we are after? And why is this important? It's important because in 2017 alone, BMW purchased over 6 billion worth of commodities. So we are talking about big money here. Which is why this question is worth to be explored. Okay, so just to kind of give you a background, BMW does have a system in place now that was put together. Our understanding is that they put it together based on some kind of an experience or some kind of research that they did and managerial experience, and they put it some guidelines of how they should share commodity price risk. And what we are basically doing, we are more or less kind of verifying whether the system works like it should by first designing our own model, making our own predictions, and then seeing how that system behaves. So here is the final slide that kind of motivates, is this a big deal? Is it not a big deal? Do suppliers take advantage? Do they not take advantage? So the suppliers do take advantage of the fact that the buyer or the automaker does not see the prices. So if you see here, so the jagged curve on the top, which I'm kind of tracing right now, is the real market curve for a particular aluminum alloy that they are buying. Actually, this is not for the particular. This is for the traded commodity. This is the alloy that they are buying, and you see that the alloy goes up very quickly when the underlying raw material goes up, but it kind of when the underlying goes down, you see kind of a very slow decline in the commodity prices that they are being reported to. So one would argue that this is the section of the timeline where they are definitely paying more than they would like, and it's not that the underlying that the alloy on the bottom is not tracking well the up, because it's tracking it very well on the upturns. So suppliers do take advantage. They are aware of the fact that the buyer does not see the prices, and they take advantage of it. So this is the overview of the talk. So I'm going to first give you an overview of what BMW is doing, of what process they have in place currently. I'm going to then describe you my model, and then I'm going to walk you through the cases that we study and kind of give you some idea of the theory results that we are getting, and then I'm going to finally talk about the econometric estimation that we are doing. So here's the overview of the industrial practices. So for a general car like a BMW 3 Series, they typically evolve on 10-year production cycles. So from design to end of production, it takes about 10 years. Even though you have annual upgrades for the car, the general design lasts for about 10 years. Before they launch a new design, so about 38 months before, they kind of complete the clay model. They have an idea of what the car should do, and they design an MSRP. So MSRP is the manufacturer's suggested retail price, which then gets reported to the dealers. 28 to 32 months before the SOP, they kind of select preferred suppliers for each part that they want to procure. So they want to get, for example, engine blocks. So they select firms that are capable of making this in the quality that they can, in the volume that they can, and over the lifespan that they. Then they tell the suppliers what kind of a contract they are going to, so what are going to be the procurement, under what regime they are going to be procuring this. And they use two types of contracts, which I'm going to describe shortly, but for now I'm just going to refer to them as PA and MP names, but the contracts are and the suppliers contract, they select the contract, and then they compete in an auction, and a winning supplier gets selected for the part and then becomes the map in it. There is a per part for the car. So action starts, the suppliers receive emails or the car maker tell maybe by smart ahead. It's to correct that. So if they give the binding forecast, there is a plus minus a binding forecast. By the way, so we need to cover. So the option to do that, but and the leaves of the parts for us rolling in parts make cars and select. So they're using types of contracts. One is a PA contract, which is a price adjustment. So the price adjustment contract is a contract that that has sticky prices. So for that contract, basically the car maker goes and says, I'm going to bring this part at this price. All that is by the supplier. The other contract they are using is called MPS, which is a cost plus, and that's basically a contract where the supplier is doing nothing more than reporting what prices they are paying, the receipt to the car maker, and the car maker pays. It's each by the. And here they give on the curve. On the example of the element being that's in that the car maker is purchasing. And the curve that's, the dotted curve that's tracing the, that's kind of tracking the solid curve very well is the MPS contract. And the dashed curve that's not tracking very well is the fixed price contract that's being adjusted in kind of these jumps or, annual increments. Okay? So now the theory of what should actually be done, what's the optimal behavior, what we actually see. So we construct a supply chain. So we have a single buyer, single firm, the assembler. So we count as the assembler because it just assembles them. We have a competitive suppliers, capable components. They can be asymmetric, but competing. I'll describe how they are competing. And a single supplier is selected from that group based on the auction. And the auction that we used in this is a single price sealed bid. The reason is because it's an auction mechanism that's very, very easy to allow to get through it. From our research, the auction mechanisms that car makers use differ. So Mercedes is using different system from BMW, from VW, but still the same outcomes, just of the auction. And is N periods, N big one, and auction once at the beginning, and component over the number. Your price for in the contract is either pegged to the index, so that's yes, or it's a fixed price, so it's a PA. Then the quantities. At the beginning, the supplier basically announces the binding quantities. Then the binding quantities within the bounds that are given in the model. Basically, you produce. So adjustment bounds are plus minus 10%, but there is no constraint. Empirically. And if we make some silly assumption about demand, like linear or something, and then the prediction doesn't work, then one of the reasons could be that we don't model demand. So we basically make very little assumption about demand. We basically just demand curve. Demand is equal to the output cap, and price demand increase in valuation, the market demand. As valuation goes up, demand goes up. As price goes up, demand goes down. That's the only thing that we assume. We assume that you curve, assume demand, and we model sales revenue as the inverse demand times the volume that you sell. And that's pretty much it. The last assumption that we make about demand is we assume that the revenue curve is concave. And this is actually not so easy to prove. What are the assumptions that lead to that? So what we do is we basically assume concavity, and then we show that it holds for loads of stuff. It holds for linear, it holds for logit, it holds for general utility-based choice models, but it doesn't hold all the time. So it's not cute, but it's fairly general. It is actually pretty difficult. Then cost table. It can change from period to period, so there is no it doesn't. And we assume that each and some knowledge to play. So I don't see the area of aluminum does not cost those. And so this is important in the model is because if you have no and the supplier to report what he wants, the reporters, as long as the contract is enforceable, you'll start getting ridiculous results. So this is how we get a notion that doesn't sound kind of a limit with the support range. So now we basically do the case, so and one straightforward, can do one that is straightforward, and a bit more time on the one which is more involved. So for the analysis, so first, so everything flows where every information is complete. So here, all the firms are privy to commodity prices. Forecast is public information, so both the supplier and the assembler have a notion of future demand. They well see what the future demands for cars will be, and there's no secrets or mystery about prices. We have more than one supplier competing for the contract in the second price seal bid auction. And then whoever wins becomes the winning supplier, and the price under this contract has two components. One is the markup, which is that's basically the supply, that's how the supplier gets paid, and the other one is the cost. So the supplier incurs the production cost, sends the receipt to the buyer, and then the markup is his profit. Okay. So now we play a game, and the game goes like this. This is actually not a game, it's more like an optimization because the supplier here is not an active player, so it's basically a two-stage optimization. The two-stage optimization goes like this. At the beginning of each period, the supplier announces the target output. Then prices are revealed, so prices are revealed during the period, and the wholesale price resets according to the formula that I just gave you. We don't know what the markup is, but we'll derive it at once we solve the first stage. So we haven't solved the first stage. The markup is endogenous, and we'll derive it, what it is exactly. But right now, we just have the price format. And then in the second stage, the supplier then makes quantity adjustment based on the revealed prices. So commodity prices get revealed, and then he says, okay, commodities are expensive, I want to cut down production. Commodities are cheap, I want to increase production. So, okay, so here's how the quantity adjustment stage works. This is basically if you are familiar with something called the news vendor model, this is not a news vendor, but it's similar to it in the sense that it's a quantity decision that's quantity constrained. So, the supplier, basically, the buyer sees the price, and it knows the adjustment bounds for the quantity. Then it goes and optimizes. It optimizes on output Y, subject to a constraint that output Y cannot exceed this bound. So this bound is basically driven by the adjustment bounds that are given in the contract, and this is a quantity QS, which was the initial quantity to which they committed. So they made a commitment, and based on this, they make a final adjustment. The final adjustment can be Y is 0, in which case they produce the initial forecast, or Y actually, yeah. And the final output ends up being whatever they committed to initially times the lower bound, plus whatever they want to adjust to. So it's basically this ugly formula. So it's a basically inverse revenue function, minus what they committed to initially, and minimum of the upper bound. So this basically this kind of an ugly formula. But what it basically says is that it's optimizing on quantity subject to a stochastic cost within the output bounds. Okay. So here is kind of what happens. this just kind of to give you show you some pictures of what happens when you commit to not enough or too much quantity. So in this case, here is a case when I'm adjusting output, and this is basically my profit curve or revenue curve here. Profit, actually. This is my profit curve. And what I would like to be is here. Here are my goalposts. So this is the minimum quantity that I have to produce, given my adjustment bounds and the quantity that I committed to. And this is the maximum. So here, if I pick these values, and this is my profit curve, I'm happy because I can produce my optimal output. I can pick my optimal output. I'm basically maximizing my profit in this given period. Here, I'm unhappy because I committed to quantity that's quite low, and I cannot go above this number. I would like to be here, but I cannot be there because I've constrained myself to be here. Is it clear to everyone? And you can similarly construct a case where you've committed to too much and you would like to produce less, but you can't. Okay? Although that never happens. But so these are the cases that I got. Okay? To construct these pictures, I assume linear demand, and yeah.
What do you mean by you commit more than what you would need for a maximum? I mean, you can commit more, but then you can, I don't know, store, for example, and avoid...
You could store, but I actually have it turns out that storing never happens in this model. So, and it's actually something that so you could, in theory, but it turns out that that case never happens. You always commit to cases where you either adjust zero and just produce the least you committed to, or you top up. You never cut back production. And the simple reason is that, just to kind of give you intuition for why this is happening, is that when you are making the initial commitment, you are incurring cost in expectation. Once you've committed, you essentially, I wish I could write here, you've committed to produce at least this number for sure, right? Because you cannot cut below that. And in some sense, that cost is sunk already, so it's disappeared, right, out of the system. Here you are optimizing, and you are basically adding in additional quantity, but the cost for the initial stuff is already sunk. So in some sense, you would like to produce more because you are not incurring the full cost here anymore. So it's due to sunk costs essentially. So you never want to throw parts away. That's basically what happens. I don't know whether I'm being clear enough, but if I could write, it would be a little bit better. Yeah. But it's basically due to sunk costs. Okay, so I need to go forward. Okay, so here is, so this is the adjustment. Here is how I make the initial quantity commitment. So the initial quantity commitment is made as follows. It's basically a kind of a nested optimization. So I optimize along each outcome of the cost. And here is I optimize over the expectation. This problem is actually very nasty, and the reason it's very nasty is because the decision variable is both in the constraint and in the objective. So it's actually not it's not a trivial thing to compute, but it's well behaved. And it's well behaved in the sense that we have a lemma in the paper that shows that this thing is concave in the commitment quantity. And the proof is actually somewhat involved, but you can prove that you have a perfect concave objective, although the Q is in the constraint, but the actual computation is not pleasant. And then the other comments are that the system works on JIT systems, so there's no inventory being accumulated. And as a consequence, this turns out to be a solution for an arbitrary period. So it's like a myopic system. So basically, in each period, you are just topping up on the right quantities and not accumulating and carrying forward any stock. Okay? So that's basically the idea for how the assembler behaves. Now, for the supplier, The supplier now enters, so the supplier can see all this. The supplier knows how the assembler is going to adjust. They know how they are going to commit. And they know perfectly how things are going to evolve because they are rational. And now they are going into the auction. So into the auction, the suppliers can write their own profit. And their own profit function is going to be quantity times the markup they make in each period, plus the cost they get from the automaker, minus the cost they have to pay. So if you see, the cost actually falls out of the system, and the only thing the supplier ends up making is the markup times quantity in each period. And now the question is, what should the markup be? So the markup is settled in the auction. So if you analyze the auction, this is a second sealed bid, second price sealed bid auction, sorry. And if you solve that, you basically discover that the optimal bidding strategy is your own reservation payoff. And if you, it's actually convenient to solve, and you discover that the equilibrium markup ends up being this, where K2 is reservation payoff of the second lowest bidder on the contract. So here, every firm bids its own reservation, so I want to get this out of the contract on expectation, and that's what you end up bidding, and you end up getting paid the price that the second lowest bidder was bidding, which is K2. N is the number of periods, and these are the quantities that you are getting. So it's basically a formula like this that comprises the spread, and the actual wholesale price is going to be the spread times plus the price. Okay. If you plug the formula into the supplier's payoff and you discover into the assembler's payoff, and you basically discover what the automaker is making, you kind of see that it has a nice property that on expectation, the automaker is making this minus a fixed number, and the fixed number is what he pays to the supplier in each period. And the reason this is nice is not only it's very tractable, but also you see that this particular contract maximizes the total output in the system. So you basically get the same outcome as if you owned the supplier, which is a very nice kind of a property. So there's no double marginalization, there's no inefficiencies due to pricing in the system, which is a very nice property, and it's kind of what you would like to see. Okay. And the takeaways are that basically the contract maximizes total output, and the suppliers make their reservation for sure under this contract. So those are the two properties of the contract. The suppliers have a guaranteed income, and the contract maximizes the total output in the system. Okay? So it's a very kind of a nice contract, and you would expect the contract to be optimal given these observations. And that's indeed what we'll see. I'm going to quickly gallop through the fixed contract. So the fixed contract is the same as the floating. The only difference is that the adjustment bounds are equal. So you basically fix the adjustment bounds, and so you cannot do ex post quantity adjustment on the contract. And as a consequence, you end up with a fixed price contract, and that fixed price contract has the following property. The supplier, again, makes K2 in expectation. The assembler now faces no risk. So the downstream buyer that payoff is deterministic. And the contract, again, maximizes total output, but in a different system. It's a system where everything is done in expectation. So it's inefficient now. And as a consequence, what you see is that with symmetric information, the pass-through contract, the MPS contract, is always optimal. So you never want to. So the takeaway is that when everybody sees everything, there's no mystery about pricing or anything. What you want is a system where the suppliers are passing the receipts onto the assembler. The assembler pays the receipts for the underlying commodities, and then everybody's happy. Okay. Now, yeah. Yes, so those are the optimal expected profits of the downstream firm on expectation, given that there is a vector of prices S, that there is a vector of market valuation for the underlying car V, and the adjustment bounds are equal. So that's basically what it is. Yeah. So those are, because this paper is done from the point of view of the downstream buyer, so we don't really care about the supplier. All we really care is about the supplier's participation in the system. Okay. Thank you for the question. Now for the asymmetric. So I'm going to quickly walk through the asymmetric so that at least I actually have a little bit time to talk about the data and see what we find in the data. So the asymmetric is very similar to the symmetric, but there are some important differences. The wholesale price has the same format as the floating symmetric, but now the cost is not the cost that we both see, but the cost that the supplier reports, which is S tilde. So here there's a potential for lying and misrepresentation. Everything else is the same as in the symmetric case. Yeah. The stages are the same, but now there's a game, and the reason there's a game is because the supplier is strategic in deciding what price to report. There is a unique optimal price in each stage that the supplier wants to report. So the supplier does not want to be ridiculous and start reporting $1 trillion for the underlying commodity, but he optimizes based on the valuation for the car in that particular period and the realized commodity price in that period. So he's being strategic. So now the stages are as follows. I make an initial commitment as a downstream player. We then, the upstream player sees the price, decide what he wants to report, and reports to me, and I then make a final adjustment. Okay. So the last stage is the same. There's no difference. I use a different representation. We use a representation using elasticities, and this turns out to be important in the econometric estimation. But there's no. I'm just recasting the result. There's no change. The difference is that now my cost is not the real cost, but it's my reported cost. Now, here is the cost reporting stage. So this is kind of a new thing that we haven't seen in the other contracts. So this is where the supplier decides what price to report. And the supplier, turns out, solves the following optimization. He basically optimizes his own profit, subject to the fact that the buyer has output constraints, and subject to the fact that there is a commonly known support for the random variable. So ultimately, the supplier ends up reporting some number as his cost. And he cannot go out of bounds, and he cannot report, and it's pointless for him to report a number that would put the buyer out of the output bounds, quantity output bounds, because what would be the point, right? And altogether, the value of this function represents an information rent that the supplier is getting out of the buyer. Okay. So now we have. Now it becomes very messy. So I'm going to kind of give highlights of the results and ask me when if you need. So the first result is that we have that the amount of information rent that the supplier extracts depends on two things. First is the demand elasticity for the underlying vehicle, and that can be estimated. And in fact, we do that empirically. And the support level. So the higher the elasticity for the demand, the less distortion you see. The higher the range, the more distortion you see. And again, we have a JIT production, so there's no inventory in the system. So again, we can run this myopic kind of a system. Now, this is almost the end. I don't mean to beat you up with formulas. There's a lot of details, but we kind of have now 3 bidding policies that depend on who knows what, and they kind of drive our main results. So if the assembler is only privy to the range and basically sees nothing else, then the suppliers end up bidding a spread that looks like this. And it's basically based on the expected value of the information rent that they are extracting. And if you see that, what it leads to an outcome for the assembler that looks like this. And this is kind of a, these terms are complicated, but the main takeaway is that the supplier in the system is facing the distorted cost. And the fact that he's facing the buyer, and the fact that the buyer is facing the distorted cost means that the contract is no longer optimal. It no longer maximizes the total output. And the reason is simple, double marginalization. So basically, you start seeing double marginalization in the system and inefficiencies. And, okay. So now, how do I stop? How do I improve? So I now have a system where I let somebody report prices to me, and they are possibly lying to me. Can I improve by doing something, right? So the one thing that I can do is I can give them the PA contract. So I can basically say, you know what? Whatever prices you are paying, I don't care. Here is the price that I'm going to pay you. So I'm basically fixed the contract, which is what BMW is doing. And it turns out that doing that is actually not optimal always. Which actually, so BMW, at least in some of the data, they from the discussion that we had with them, they thought that this was an optimal kind of a move. And it turns out that it's optimal in some cases, but not always. So basically, it turns out that it's optimal only in cases when you are buying from suppliers that are relatively small. So the small suppliers turn out to be the more difficult liars in some sense. And the reason is that small suppliers don't get very much out of the contract to begin with, because if you think the auction format reduces everyone to their reservation, small suppliers don't get very much out of this, so they get most of their profits from distortion. So they are the ones that are kind of more dangerous in some sense. And the big suppliers don't care as much about distorting because they get their money elsewhere. And so basically the takeaway, which is the proposition, is that when you are buying from somebody who is big, then it's better to let them lie to you. When you are buying from somebody who is small, it's better to not let them lie to you. Okay? So that's the first takeaway. So it turns out that, do I care that somebody reports to me? Yes, I do care, but not always. And then we have a final result here where we basically construct a mechanism where you can get the revelation or something very close to revelation, but that requires less of an information asymmetry. So if the supplier is a little bit more informed, then what we basically require is that the supplier knows the distribution, but doesn't necessarily see the prices. So how can that happen? Well, you can see historical values, for example. From that, you can construct a distribution. And if you know the distribution, then you can have a mechanism where you get a revelation, or something very close to revelation. And the function is obviously messy, so I don't include it in the presentation, but it's in the paper, and if you are interested, you can have a look. Yeah, so I think I've covered it all. So that's basically what we get. So just to kind of summarize, what we are finding is that when everything is symmetric, you want to let prices float. When things are asymmetric, you want to let things float if you are buying from big players, and you want to fix them when you are buying from small players. And this insight also hinges on what kind of a car is that and what kind of a volatility is that. So when the volatility of the underlying commodity is very large, then in general you are going to be more prone to fixing prices, and when the demand for the underlying car is very elastic, you are generally prone to less fixing prices. Okay. So now, do these predictions pan out? So I'm going to kind of talk a little bit about what we find and how we measure it. So what we have is, what I have is about 10 minutes. So in the 10 minutes, I try to walk you through the empirical part of the paper. So what we basically have is we have contracting data from BMW. So this particular model can be applied to just about any car manufacturer. Well, maybe not any, but many of them. So VW is using similar system. Mercedes is using something similar. I think GM is using something similar as well. So from what we read, at least. Okay. So what we have is, but we have data from BMW. So we have this general model that we test on data that came from BMW. So what we have is the data was started being collected in 2009. So it's a fairly large data set. And they use two types of contract, the price adjustment and then the MPS contract. And then we have, how many do we have? We have 300,000 contracts from 1,600 suppliers in the data set. And we have information on the underlying commodity. We have information on the suppliers themselves. We downloaded financials for the suppliers, so we know a lot about them. And we know the contract type, the tonnage, the value, the underlying component, the plant, and the supplier name for each component. So it's a fairly, it's quite a bit of information. And so what we test is we use a linear model, but there's some caveats to using it, so I'm going to talk about it a little bit. And we basically test 4 takeaways, the 4 qualitative insights that we get out of the model. We test how the model behaves with respect to volatility. So basically here, we don't quite know what volatility will do to the model. So it could either lead to more price fixing or less price fixing. And the reason is that it will lead to more price fixing if it means more lying, and it will lead to less price fixing if it means not being able to adjust. So it depends which. So on one hand, if you fix prices, you don't get lied to, but at the same time, you cannot adjust. So you would like to do both, and it's which one of them is more dominating. We have a prediction on elasticity. So we predict that if the elasticity of the underlying demand for the model of the car is high, then you are more likely to give a floating contract. If it's low, then you are more likely to give a fixed contract. We test on the reservation payoff of the firm. So if the reservation payoff is high, you want to fix more. If it's low, you want to fix less. And finally, we test on the information asymmetry level. So this is the last result that I said that it's possible to construct contracts that give you high level of revelation, but you need to have a less information asymmetry about that particular commodity. So there are, I'll discuss it in a second, there are commodities where the buyer does not know virtually anything, like rare earth metals, because it's just the market is completely dark. And some markets where I have a very good notion of past prices and I can construct some distribution, and in those cases you could construct contracts where you get very near revelation. So these are the variables. So for the contract type, we have this basically 0, 1 coded, pass-through is 0 and MPS is 1. For volatility, we use all kinds of stuff. We use range, we use volatility of the commodity, we use all kinds of stuff, and the results don't really change. For the payoff, we know total value of the contract. That's actually in there. And from the auction format, the value of the contract is the reservation value of the player. That comes out of the theory. We cannot use that number, and I'll explain why, because of endogeneity, but we estimate it through other means. And then there's information asymmetry. So commodities at BMW are classified by their opacity, and they get indexed. So very opaque commodities get particular level of index, and non-opaque commodities get a high level of that index. So this is how we do the elasticity. So we know which part goes to what car. So we basically conjecture, and it turns out to actually work quite well, is that the low number series, so the 1 through 5 series, are cars that are fairly cheap. They, well, not cheap, but they are cheaper, and they sell in high volumes. And at least in the US, they sell in the range south of $50,000, which, I don't know, in the US, a Golf is about 35, so it's basically not that big of a difference. The 6 and 7 series are cars that are significantly more expensive. They sell in lower volumes, and they sell north of 82,000. So it's a pretty big difference. And we basically conjecture that people that buy the low-numbered series cars are people that are price sensitive, and people that buy the high-numbered cars are people that are not very price sensitive. If somebody wants to blow $82,000 on a car, they probably don't care about $1,000 increase. So that's how we capture elasticity. Now, we have two issues. For the reservation payoff to model, there is an endogeneity issue because we don't measure it exactly, so there's some error of observation. And if you try to run the regressions with the data that's, with the actual contract values, you don't get anything. So what we do is we estimate the reservation payoff from two instruments. One is firm size and the other one is a firm age. So we conjecture that as the firm gets bigger and older, it's a more of an established player that demands higher contract payoffs. And it turns out to be a pretty good predictor. And then for the opacity, we use the classification by BMW, and then we use, there's a paper by Rauch, which one of my co-authors found, that gives commodity classification as opaque and non-opaque. So we use both. And we run it on both, and it turns out that both yield the same results. So I'm nearly done. So if, a couple of more slides, and then we can basically wrap it up. So here's the results. We run 8 models. The reason we run 8 models is because we run different combinations of endogenous and non-endogenous values. And in the interest of time, I'm not going to go over the numbers. But basically, the gist is this. All the predictions check out. So what we basically find is that as you get more volatility, you start doing more price fixing. So from that, the takeaway is that BMW operates in markets where if they are being lied to, they are being lied to quite significantly, and volatility is an important important variable for them. For a different car manufacturer, that hypothesis could have gone the other way. But this is what happens for BMW. As elasticity goes up, they tend to use, as elasticity demand increases, they use more of a pass-through. So they do price fixing. So elasticity is a predictor of what they are doing. And as reservation payoff increases, they do more pass-through. And as information asymmetry increases, they do more price fixing. So that basically means that for the commodities where they have a good sense of what's happening, they tend to let it float, and they are okay with being lied to a little bit, because what it buys them is the ability to adjust. So, and that's basically the talk. So I hope that you found it somewhat relevant, and that you learn at least a little bit. And if it's a little bit to the to the left field for some of you, because you are doing mainly finance, I do operations, and this is what we worry about. We worry about nitty-gritty details in production. So that's basically my talk, and I'm happy to answer any questions, and I'll talk to you afterwards.
Okay. Any question?
Yeah.
Yes, thank you for your presentation, which is very clear. I have a question about the results. Would you get the same results for another car maker?
Another car maker? So I cannot obviously speak to that. I would hope so. I mean, I'll tell you this way. In the theory model that we have, there is nothing that's particularly restricted to BMW. So if another car maker is doing what they are supposed to, in some sense are being a rational kind of a player in the market and have the level of understanding that these guys do, then I would expect the results to hold true. If not, then I would be interested in why that is. And it could be a million reasons. It could be that for example, one of the things that BMW mentioned is the following. Sales or like relationship managers' incentives. So for example, BMW noticed in the past that some of their relationship managers were doing floating price contracts in cases where they were clearly told to do fixed contracts because they were lazy. It turns out that in their system, doing the fixed price contract is more work because every period they have to go in and manually reset the price in some spreadsheet. Whereas for the floating, it's just automatically resets. So to save themselves work, they were doing floating contracts, even though they were not supposed to. So that would mess up your empirics, even though there's a full level of understanding of what should be happening. You don't see it happening, and it's because their system the incentive system is not working correctly. So there's not sufficient punishment for this behavior. So those could be things that could throw you off. But otherwise, there's nothing here in particular that restricts it to BMW. Yeah.
Yes.
Yeah.
Thank you. If I understood correctly, at every step of your procedure, the agent involved tries to minimize some kind of revenue or its position, and by doing this, is performing some kind of hedging strategy with a partial information. At the end, the original question you proposed, who is the main eater of the volatility in this setting? I would bet on the assemblers.
Yes.
I'm not sure.
Yeah. So in industry, I don't exactly know what the breakdown of the floating versus fixed contract is in the data, but there's a significant portion of the contracts that are floating. They float everything where they see the market, and they float some where they don't see the market. So majority is going down, basically. And basically, if you summarize the analysis, the only cases where you want to fix is when you are buying from small players for types of cars that have very elastic demand. There's a high volatility on the underlying part, and you are going to get lied to. So those are the cases where you want to fix.
Thank you very much.
Yeah.
Okay, thank you, Danko. Thanks to all of you. And so the next webinar will take place in December. There will be a presentation on Bitcoin and cryptocurrencies and blockchain. Thanks.
Okay.